Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is April 23rd. We have Nomi Prins and Ira Harris, and also Judd Hirschberg. Judd is from White Wave Trading, and he'll be able to put up real-time charts as we're discussing. And Nomi's background, before becoming a renowned best-selling author and public speaker, Nomi reached the upper echelons of the financial world, where she worked as a managing director at Goldman Sachs, ran the International Analytics Group as a senior managing director at Bear Stearns in London, and was a strategist at Lehman Brothers and an analyst at Chase Manhattan Bank. She's written several great books on finance and economics. She has an insightful Substack, prinsights.substack.com. Ira's independent trader, past hedge fund manager, and global macro consultant, trading commodities, foreign currencies, equities, bonds for over 40 years. He was also CME director from 1997 to 2003, and also a stint most recently. Welcome, everybody.
Thank you. Thanks for having us.
Thank you so much.
Yeah, I thought we'd begin, Nomi, with your global macro view on the economy and the financial markets.
That is an excellent place to start. It is big. Obviously, we have seen a lot of chaos in the markets, in particular the U.S. market, given what is transpiring with tariffs, particularly the 90-day current pause period from when tariffs were announced in mass of a 10% sort of floor, and then other higher points relative to trade deficit percentages with other countries around the world. And then on top of that, an extreme tariff battle with China that we're still engulfed in. And that has obviously dampened the markets. It's dampened the US dollar, which is interesting because normally the dollar is seen as a safe haven type of an environment, type of catch-all. But what we're seeing now is more of a move to gold and other currencies as safe havens because of the instability of US markets and the uncertainty around tariffs. And then on top of all of that, we have economic slowdowns, or at least stagnations, that are occurring with respect to forecasts of U.S. economy, of the European economy, the UK economy, China, India, and so forth. Some of those are growing more slowly. They're still growing and outpacing the U.S., but we have just a lot of flux in general growth, combined with tariffs, combined with market uncertainty. So that's what we're in right now. What has shined and literally shined in the wake of all of that, again, is gold and some of the real commodities. Gold, silver has not caught up yet, but the reason gold has done so well is because in this environment, in the seeking of a safe haven, and a place that's sort of devoid of political turmoil and geopolitical power plays, gold has stepped up with all its other reasons for being important in this type of an environment as that safe haven from not just inflation, but again, from geopolitics and power plays. And I think even though gold has come back a little bit as we're talking today from having touched a high of 3,500, that's temporary because these ongoing strains are going to continue. And also it's not just about gold, the commodity, it's about what it represents as the shift in geopolitical power in the wake of US policy and global reaction.
That's an interesting perspective. Your thoughts, Ira?
Well, it's certainly all been the case, and I've certainly been looking at this. As you know, Richard, with all that we've done here between Luke Rome and others, I've been in this bearish dollar camp. I thought the people were touting a higher dollar with the tariffs. We're reading from a playbook that doesn't exist whatsoever. And if you saw Bissent this morning, you wonder who the adult is in the room. There's no question about it. And I'll get rid of everybody else because they're not worth much except for their own egos. So we have all that going on. And the dollar is, to me, performing. And if you listen to Bissent this morning, he talked about it. The dollar, and he's been honest about this for 6 months. The dollar will gain its strength. Speaking off that damn Bob Rubin, going back to 1997, 98, strong dollar mantra, which was pure nonsense anyway, because in June of 1998, the U.S. actually, when he was Secretary of Treasury, they actually intervened on the yen at the behest of the Chinese, by the way, in June of 1998. So you had the U.S. when the yen was really weak. The Chinese were complaining about the weak yen. And of course, the U.S. Treasury on its own started selling dollar yen, which was kind of interesting. So Bissett goes there, and again, he says this morning at the IIF, which was a remarkable speech. Of course, I'll be interested to see the way the media reports it. It's like the old line about the motorcycle guy wearing a MAGA hat who goes over the fence to save a child who was being eaten by a lion at the zoo. And the media, of course, reported it that when they saw the MAGA hat, that a MAGA person stole the lunch from an African immigrant. So we can all, and that's how they'll report Bissett out. And that's not a political statement. That's just reality. So we'll see what they talk about Bissett. But Bissett was absolutely phenomenal. And he said, yet again, he doesn't worry about the dollar. Because if the United States does the right things, the dollar will take care of itself. So if the dollar does go down, be it 10%, 15%, 20%, and it does it over a slow period of time, let's say it's 18 months, let's say it's 12 months, and the dollar does it, the tariff discussion is ridiculous. That's the chainsaw discussion. The dollar going down, and I don't need to call it Mar-a-Lago. I don't need the Accord. I'm old enough. I've traded through the Plaza Accord, as many other, and the Louvre Accord. But the dollar will take care of itself. And Bissett was adamant about that. Get the deficit under control? Yes. And if I get the deficit down to 3%, and Nomi will, the U.S. economy is going to go into a slowdown. The slowdown will start diminishing, of course, the trade deficit, which is run out of control based on the back of American exceptionalism, which was based on the back of fiscal stimulus. So we're at this juncture, and the gold, we're going to talk more about the gold. And the gold I've been bullish gold, but gold has been very anomalous, and nobody will answer it for me. Why only gold? I look at I've been on this, and I'm not trading it, but I look at it. Why gold silver at 105 to 1 is so ridiculous in the middle of a metals rally. And I've traded metals rallies that'll be 48 years. And then platinum at negative 2,500 to an ounce of gold. If you believe that these precious metals are stores of value, why is gold the only store of value? We've never seen this. So is it, and I'm of the mindset, it's not the ETFs, because the ETFs just can't play like this. It's not the Chinese and the Indians, because the Indian central bank, they'll never chase momentum. So who is the force behind this? Who is, I have to believe it's sovereign wealth funds, but we'll get into that. So I'll stop there. Everything that Nomi said, I 100% agree with. And I know we've crossed a lot of paths in life. She was at Chase, and I've been around the foreign exchange markets. Owen Brown is a very, very dear friend of mine, still is. So I'm anxious to, Richard, it's all yours.
Maybe Judd can bring up some charts on gold in the meantime. And just wondering your thoughts, Nomi, like what is driving gold? Is it just central bank buying? Is the investor community, maybe in the Asia Pacific region, buying? Is it due to a neutral asset versus U.S. Treasury bonds? What are your thoughts?
Yeah, I think there's a combination, and I agree with her on the there is this large dislocation between gold and silver right now, and silver should by rights be moving more closely to gold. But I think the fact that gold it has a lot of those properties, but it's also a tier one asset. Now it's been a tier one asset, as declared by the BIS Bank, or National Settlements of the Central Bank of Central Banks, for 5 years now. But there hasn't been as rapid an accumulation as we have seen over the last 18 months. And what's happened is the allocation of reserves to gold has increased at central banks. That doesn't mean they are taking out all of the gold from the system or from the ground, or demanding all the gold that's in the ground and also in the system. But what it does mean is there is an external need and path of one large actor, the central banks, accumulating gold during a time where what else is happening? During a time where, 2019, when gold became a tier one asset, that was also when, we were sort of in the wake of the tariff wars part one. And one of the things that China, for example, was doing at the time and has expanded doing over all of these years, and more so in the last couple months, is increasing its trade partnerships with Russia, with the BRICS, with Europe, with South America, and so forth, and become a much larger force in trade. And so after you become a force in trade, and there's all the economic and manufacturing production reasons why that's the case, there's also transferring contracts to be not just dollar based. Now, this doesn't mean, the death of the dollar. It's not going away tomorrow, and it's not even why the dollar is particularly weak now. It's just one factor. But it does mean that actual trade agreements are actually being penned, and more countries are trading directly with China versus the choice of trading with the United States. That's just also accumulated. So then you add that to, well, how does gold play into that? Well, gold is simply a more autonomous and sort of non-politically active currency, if you will, but a hard asset that can be used as a reserve. Then you put on top of that the trend, and I agree with her. It's not so much that ETFs are moving upward, in terms of the shares of ETF prices. And I look at the ones particularly like IAU, which is gold backed, or more or less gold backed, versus the ones that are sort of more paper futures oriented, because you do want solid stuff there, because that means solid stuff i.e. gold has to be, part of the equation. So that has had like a 4-month run in terms of even the Western market. What's happened is in the last 4 months, and particularly the last, I'm imagining when we see this quarter's results, we'll see that even more so. The sort of Western investor has been buying into gold and buying into ETFs more so. And I mentioned sovereign funds. On the Chinese side, not so much sovereign, but their state-owned banks are now also positioning in hard assets and buying gold, and being told basically to not do transactions in dollar. And that's not just in China. These are banks that are operating across all of these partnerships throughout the world, and through digital payment system that also is probably going to accommodate that gold as well. And all of this stuff is happening while now Western investors are coming in and saying, wait, did we just miss the gold run? And yeah, some are stepping with ETFs. There's been a lot of private vault and those sorts of purchases that have been bought. I know, for example, that Morgan Stanley has been starting to tell all of its high-class private wealth family investors to reallocate more percentages into gold. And that's just one voice. JP Morgan has talked about gold. So when you have this whole confluence of factors all at the same time, put on top of that no one actually knows what's going to happen with tariffs. And I totally agree with that. But the only adult in the room right now, and he does make a lot of sense. And I think he's been caught out trying to explain some of this policy when it doesn't make sense to him. And what he's come down with is this policy is basically not sustainable, as he said the other day, and now he's talking about other, the speech today. But that all plays into gold. It all plays into where we're at right now in this moment.
Great point. Your thoughts, Ira? Does it seem to you that gold is being used as an international currency reserve asset only and not therefore silver and platinum, as you mentioned?
Well, yeah, and it evidently is going on. I don't fight markets, and it has been interesting, because if I hear one more CNBC analyst tell me about inflation, I want to throw up, because I've never been a believer that gold is. By the time you're buying gold in response to inflation, you're already deep into something, and you saw it during the transitory inflation of the Jerome Powell Fed. Which was totally wrong. Gold has historically, especially since 1971, but I'd probably go back to the 1920s, it's a statement, and it's a belief about the credibility, and I'll say this ad nauseum, about the credibility of central banks. And that's what's been called into question. Why? Because, and Judd's work has shown this, and we've looked at it all, gold versus the euro, gold versus even the beloved Swiss franc, which is running negative yields right now on short overnight money. Even gold versus, these are all at historic highs. The gold yuan, the gold is so it's a statement, and I think a rightfully statement about central bank credibility, because the central banks are too well locked in at their hips. And I blame that on the G30. And you can take the G30 and stick it where, because they're not worth a crap. It's a bunch of academics who have served in public policy, who meet and have way too much influence on each other. It's a giant echo chamber that needs to really be corrected. I'm opposed to the G30, and I can give you a classic example, because when the Fed moved to open or set up the standing repo facility, well, that was done at a Fed meeting in July, and what do I want to go, 21 or 12, when they set it up. But the FT ran an article coming out of the G30 6 hours before the Fed statement talking about this. Why did the FT know to run that statement? And I'm sorry, that calls in your credibility. And all it's done is get all the central banks. It's like they copy off of each other's statement. They basically all read the same, except for the Swiss, who talk about their need to intervene to weaken the Swiss. So the gold is that statement. People really right now are doubting the credibility, because they saw the Bernanke doctrine was, look at Fed policy, just in case people didn't realize up to then, is totally asymmetric, meaning we will err on the side of quantitative easing and creating liquidity before, and fight against inflation. It's an asymmetric battle, because the Bernanke doctrine was built on the fact that Bernanke's premise was that they failed, the central banks failed in the late 20s and early 30s, and that was never going to happen again. And that's a quote from Bernanke. And they erred by there was never going to be an amount of liquidity that was enough, right? Santelli's famous rant, which I took him to task for, not that the rant was, but we go back to Andrew Mellon, and that's what Bernanke feared. Liquidate the bankers, liquidate the farmers, liquidate everybody, because it was a Calvinistic view of the world. You borrow too much money, the hell with you. And that was Santelli's Tea Party, which is, we don't want to, but QE1 was necessary, because what Bernanke rightfully depicted was the United States could not take a liquidity crisis turning into a solvency crisis. That gets you 25% unemployment, undoable. Hell, when the United States got up to 11 or 12%, the foundations were shaking. We were never going to go through the 30s again. So that's so, and rightfully so. I think global investors have looked and said, well, we know where they're going to err, and they're going to err on, again, creating too much liquidity, which calls into the question central bank credibility. Because even gold, and Richard, I've been on these podcasts for years already, and I sense that Nomi's going to agree with me, which is when real yields in 22, 23 went to 2% on overnight money, gold never corrected. And I stood in this podcast going, I'd like to buy gold at 1580 to 1620 and load the boat there. But gold really never got under 1780, which, based on real yields, overnight real yields, because the long end is a different story, because the Fed, unless they do yield curve control, doesn't control the long end, except when they're busy buying. Yeah, so we know that. But the fact that the gold never corrected that low, to me, was amazing, which told me there's a different story going on here, and that's what we've seen in the gold.
Great points. From a technical analysis perspective, Judd, what are you seeing in the gold market, short term, medium term, long term? Can you
Well,
explain a bit? Yeah.
the short term was yesterday. I got a signal off of gold Bitcoin, so I bought Bitcoin as a risk on surrogate against the gold. And the last time we've been up, every time we've gone up in the euro, this is a 2-year channel on the weekly. Every time we've gone up there, we've corrected almost $200. So this is just a normal correction that we're in right now. One of the other guys in the room had the stone cold low today. I thought I was going to get another $20 lower. It never got filled. So I still like the structure of it. I still have much higher targets. It's just how it sets up again, because all these there's gold in yuan, gold in yen. And it was gold and euro that got my attention yesterday. That and Bitcoin gold.
What are your targets showing?
So I still have much higher targets, and I'm kind of with Iris. It's where trade location.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and market environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
Okay.
Anything else you want me to look at, guys? Happy to.
Yeah, maybe we move to a discussion on in Japan, the yen. There's been issues with tariffs negotiations between U.S. and Japan. U.S. demanding a strengthening of the yen to 120. What are your thoughts, Nomi, on that? Like, just in general, also, are the tariffs being used to isolate China? And in particular with the trading partners, like between Japan and China, do you see that happening?
Well, I see that being a want from the standpoint of the United States, from the White House. It's been clear, and I don't know how much this was pre-thought or it was just sort of reactive, that in the sort of unfolding of this bucket of tariffs, that the major target was China, and how to either back China into more discussions about a different type of tariff agreement structure or whatever else. But what's happened in the wake of just how it's unfolded is that China has basically come out and said to other countries, look, be wary of the agreements that you pen with the United States and not with us. And that was basically coming from the finance ministry 2 days ago. So even while negotiations are happening with the US and China, in a sense saying, look, this is unsustainable, which is true. This is like an embargo on trade, which is true. There is still a lot of sort of infighting going on, which I think will ultimately subside, a lot of it, as he has said, but also to position in terms of trade strength around the world. And so back to what I was saying before, with respect to Japan being in the middle of that, of course, Japan trades with both countries. The United States can't make the yen go higher. It's basically trying to say, look, the flip side is to want the Fed to go lower. So one of the other things that Trump is doing is sort of recalibrating his comments in 2018 of Powell being off to golf and, so not being able to run things and being incompetent. I'm paraphrasing to the same thing today, like that, effectively the Fed should be cutting rates. That would have the, potential ramification of increasing, the value of the yen just by math. The other way to do that is for the Japanese central bank to raise rates, again, because of the math. But they are also sitting on a massive boatload of JGBs, of government bonds. So they have this ongoing debt problem relative to GDP. It's been since the 90s, but it continues to go on. So it's very hard to decide, or have the US decide, how that's going to actually fall out from the outside. But all these things could be factors. But I think what's happening, and this sort of goes to one of Eric's points on the Fed, is that, and Bernanke and this whole idea of enforcing liquidity over insolvency, the banks are struggling. I mean, that's the reality of the situation, as is the government, to pay the debt at the levels that the debt is at right now. We're about 37 trillion, 36.8 or whatever of debt right now. There's a significant bill each year in terms of debt. The banks are sitting on $650 billion, almost $1 trillion of unrealized loan losses. And the Fed desperately doesn't want that to spill into this. That's a lot of loan losses, and a lot of that is credit oriented, so that there's credit derivatives associated that with and everything else, and they don't want that. And that's one of the reasons their book still is just under 7 trillion, having reached 9 right in the wake of COVID. It's not that much lower. And while they pivoted back from having quantitative tightening of 25 billion a month to 5 billion a month at the last FOMC meeting, if they go back in and sort of go to QE, or I think that's effectively zero, but go to QE or anything else that has the potential impact of lowering yields on the long end, potentially on a comparative basis, higher yields relative to other currencies like JGBs or that. So again, there's just a lot of pieces to this puzzle, all in flux right now, but they're all connected in this way.
And your thoughts, Ira? That's interesting points from Nomi. Yeah.
Yes, yeah, and especially on the yen, I've been in that very bearish camp and have had some very public arguments. And I don't want to hear about the independence of the BOJ, because I've had a discussion with somebody very close to me who was very knowledgeable, but I've never believed the BOJ is independent. And UATA is another one out of those G30 out of MIT. It's amazing. It's amazing how the linear camaraderie, but the yen, I believe if the yen went to 125, it wouldn't make that big a difference. You already have seen the Nikkei undo a lot, and as Basant talked about this morning, based on Abe economics with the 3 arrows, of course, which he was a big fan of. But can the yen go? Yeah, the yen. And again, the philosophers it ought to be going higher. There's a lot to be said about Japan, and I'll bring this up. Everybody, listen. I'm a fundamental analyst. I believe everything that I do starts with my fundamental analysis. And carry trade, which the weak yen was certainly the recipient of, that people have gotten locked into that mindset that everything is interest rate differentials. Well, I guarantee you, that's a myth. That's like everything else. Because don't forget, the Japanese were at zero when dollar yen was at 75, 76, 77, 78. Why was that? Well, because Japan had actually deflation, and Japan's real yield was far higher at zero interest rates than the U.S. was at 5. Because if you're running 5% inflation, 3% inflation, 4% inflation, your interest rates are 4%, that's an effective real yield of zero. But if you're in a deflationary period and it's one of the problems of undergoing deflation, because you get yourself into that bad cycle where the currency kept going higher, and Japan didn't need a stronger currency. And then when they finally got it right and they started weakening it back in the mid-90s, because other things were going on around the world and nobody wanted to be in Japan at zero. So we got the yen up to, it went from, at that time, probably 95 up to about 135, 130, actually 147, I believe, without looking at a chart. So all of these things are taking place. Now it should be reversing. And I think that Basant actually talked about that this morning too. It's very, I'm grateful that he talked this morning, because it clarified a lot. And it was really good. The Q&A afterwards was quite good. But the end, and again, going back to Ishiba only got in because the middle class in Japan was very upset about the weak yen, because they were being negatively affected by it. Japan imports a lot of stuff. That's why when people talk about the dollar is going down, it'll impact inflation. Maybe, but it'll take far longer. It's because everything in the world, and this is where an idiot like Kudlow, who all he has is his laugher napkin, sorry, but that's a fact. He may as well get in his hot tub with Navarro, because the two of them are so one-dimensional, I can't take it. So it's all about the laugher curve. and I'm tired of their nonsense. So that's all he has. But he talks about, well, if the dollar goes down, inflation will go up. That's a gradual process because the United States is still the reserve currency. So if I need to buy grain and I have a weaker currency and I need to buy imports, it's still priced in dollars. I'm not converting my weaker dollars to a stronger currency like everybody else. So that's a myth that gets told. It will play out, but not, there's a window of opportunity. That's why I would say let the dollar go down rather than jumping into this tariff game. And if I had Vicente sitting next to me, I would ask him that question, and I'm sure I would get an interesting answer. And I see Nomi shaking her head. So if the yen really needs to go down, if it went to 125, the Japanese middle class would be far better off. Would Japan lose some exports? Maybe to China, because the Chinese are certainly holding their currency here at around 7.30, 7.25. And actually one of the charts I watch closely is the yen yuan chart. And Judd could put that up because it's a very important chart. Yeah, China will lose some, and China will lose some competitiveness within Asia, of course, depending on what South Korea and Singapore and Vietnam, it will, of course, depend on what they do. But 125 is not a death. It puts them in the death throes. I don't care what anybody tells me. They've learned to live with that. And if you probably talk to corporate Japan, they always have a number that they feel comfortable that they can exist at. And I can tell you something else. Now that everybody's ramping up defense spending, Japan exports in the defense sector are going to boom. Maybe not, it's just like with Rheinmetall and Leonardo and Thales and, the European defense, the U.S. defense sector is going to get blindsided here because they now have competition. Their monopoly, oligopoly situation is now over because we know this. The Japanese are great engineers and they're great at re-engineering things. Could they build planes? They could do that yesterday. This is not like China seeking out. The Japanese are capable of doing it. Germans, they can do anything that they want to. They have the engineering capability. So U.S. defense sectors, they should have used their strong dollars to purchase some of the, like they used to do back in the 60s and 70s when U.S. multinationals were using an overvalued currency to actually make foreign purchases. But we're in the throes of all this. I think the world would be, if the dollar, again, I'm in this camp, I'll be in this camp. If the dollar went down to 80, and I hate the dollar index, but if I have to use that, if it went down to 85, to me, doesn't make that big a difference. And actually, I would argue that more people would probably then come looking at the U.S. bond market because there'd actually be value there. It's tough for me as a foreigner to want to buy a U.S. Treasury when the dollar is at 105. I just don't see it because the United States is far too irresponsible on a fiscal basis to warrant that.
Thanks, Ira. And speaking of the U.S. bond market, in terms of looking at U.S. Treasury bonds, Nomi, for like the long end of the yield curve, 10-year, 30-year, and Judd, if you could bring up charts as well. What are your thoughts, Nomi? Like what's been happening in the last 10 days where you have U.S. dollar down, U.S. equities down, U.S. bonds down? What is your interpretation of that, or who is selling?
Well, I think basically that the world is effectively, and so the investor community, just because of, not wanting to be behind that trend has been selling the markets, the dollar. Bonds have kind of, sort of done better just recently, but we're at like 445 or so on the 10-year, and that's with the weaker dollar. And again, that's counterintuitive if so much other things weren't going down, because historically, you would think if there's a weaker dollar, then yields would also be down. And at that point in the 10-year, yields were actually increasing. There's a sell-off of bonds. And I think part of that is because of the international community selling U.S. bonds because of the uncertainty that we've been talking about U.S. policy and so forth. It's not different from, I mentioned, Japanese defense sector or just any other sector in the world where investment is flowing because the capacity is there to take over production or trade or create relationships with other countries in the wake of the uncertainty that has been introduced into the United States. It's the same thing with UK defense or just other sectors where there has been less investment. And so what do? You take the investment out of the market where there's the most uncertainty, and especially at the safe haven of the dollar, because that's a part of that market. It's connected in a way in this period that, it hasn't sort of been. Generally, you'd be going into the dollar in periods of uncertainty and looking at any other form of investment. And one of the things we've been doing, and I look less honestly at currencies in terms of our portfolios and more at sectors and asset classes and names in our products. And we've been very much positioning into European names in defense, in energy, and infrastructure over the last 6 months, really, but more so over the last 3 or 4 months, because that is where not just investor flows are going, but they're going there. The markets are going there because the fundamental ability to produce outside and to have external trade relationships, which this tariff period has catalyzed, or recatalyzed, I should say, is there. This isn't to say every company's leaving the United States or everybody's redistributing how it is they operate. It's not that. But money can move much more quickly than companies can move. And so what we're seeing is money moving into areas where companies might move or are moving very, very slowly, but it just happens to move faster. And that's really what we're seeing.
That's interesting. And your thoughts, Ira, do you still like some of the European banks that you mentioned?
Commerce, I've been beating the drums on Commerce for 3.5 years, and we've seen the move because I believe it's this time it's a genuine takeover target because I'm a believer that Christine Lagarde is going to get her capital markets union and her fiscal harmonization because the Germans, and we'll come back to that a little bit, but because the Germans, I think, will get in this. Macron needs to shut up. Because the more he talks, the bigger the hole he digs in. He's just not that good. I have to explain that to him. He's not that bright. He's not that good. The more he talks, the angrier the Germans get anyway. But that's and nobody's right. There are. Listen, I believe that. I'm a big, and I've been again when we bought Commerzbank, and we were very open about it in this room. And I also love ABB, the engineering firm, because it's a Swiss. I mean, so it's really good engineering. The Swedes, I miss them. They're also ramping up their defense sector. And the Swedes do pretty well. They had Saab and others who were really good in the defense sectors and didn't mind spending money for a bunch of pacifists. So they're pretty good at this. So I like it. I love ABB. And Besant, again, coming back to Besant, he made a comment this morning. He said, if you did anything to finance Russia in the Ukraine war, you will not get any of the contracts in rebuilding of Ukraine. He made that adamantly clear at the IMF and the World Bank. And all I thought about was ABB. Because I know who's got not everybody can re-engineer this stuff. And those contracts, as Nomi taught, these are going to be big because they are going to rebuild Ukraine in some way, and other people are going to take on other roles. So, I still look at that, Richard. And again, if Lagarde pulls this off with the Capital Markets Union, they've been adamant saying that they'll go to a broker-dealer system with a euro bond, which they badly need, or otherwise this whole thing is going to, maybe 10 years it'll be over because you can't just have a currency. The world has proven that over and over. And they did this, I'll say it again, and the great Bernard Connolly has taught me more about this than anything else. They did it backwards, where they should have done the fiscal harmonization and a euro bond. They went for the currency first because it was, in typical European fashion, the lowest hanging fruit. And after the unification of Germany, they could get Germany to sign on it and everybody else was signing on it. So, I mean, European banks especially, because what did the EU say and the ECB? You have to be domiciled. They don't want Goldman Sachs from Wall Street running the European bond market. They will not tolerate that. So you're going to have a presence there. England is we'll see what happens there. But and that's what's made me bullish. But I agree, and I think as again Rheinmetall, but these are stocks have already run, so I'd be patient. I'm not jumping in. It's just like I'm not telling you to run out and buy Commerzbank, but I still can't believe that somebody like Citadel, or even though I know Cerebus at one time owned 10%, although they sold off after stake, not very well. They got tired of it, but they owned 10% of Commerzbank at one time, and they were pushing the course for a lot of this stuff. But this is going to take a play, and I would get bullish. And believe me, anybody who knows my thought process for the last 25 years, certainly on Europe, it's hard for me to be bullish Europe, but everybody's time has come. And if they get a capital markets union, I would expect the euro currency to have a pretty solid move, because then it becomes much more desirable in its, is what's his name? Somebody said it from the ECB today, that a reserve currency, which is what they've dreamed about, but you can't do it with half measures because nobody's going to give you that. Right now they're all living off the German credit card. And as long as Germany plays in this, and going to what Nomi said, if you go back to that day when MERS went backwards and got that deal done on the $850 billion of stimulus between infrastructure and defense, the German financial markets did something that day that everybody on CNBC will tell you it's not possible. The DAX rallied 4%, while German Bund yields went up 35 basis points. Now, that could be done if the DAX, if we were back in March of 2009 and and the stock markets are on their lows, but the DAX put on a 4% rally when it was already that day, the day previously, at all-time highs. So that's an amazing feat for financial markets. 35 basis point increase in your 10-year yields, and your stock market rallied 4%. Nobody's onto it, and there's something much bigger going on. Now, the DAX has corrected quite a bit, rightfully so, as they're trying to, go through the Trump minefield of the world would be better off if somebody would break his damn fingers. But more importantly, if the SEC would come out with a statement saying all politicians of stature like that, you're not allowed to tweet. And if that's imbued as curbing your free speech, so be it. Your position comes with some. This can't go on. This is absolutely preposterous. And as for Biden and as for Obama, none of them should have this ability, because it moves markets and it really questions the integrity of the markets and of the people. So the SEC should say this should be outlawed. But that's another discussion.
Can we look at the DAX versus the FTSE and the SP 500? Is that possible just over this period? Because just what you're saying. I mean, yes, everything's kind of pulled back, but we certainly have movement. Again, into your sort of underlying where things could go and the uncertainty in the States. And I love ABB. It's funny you mentioned that. It's not actually in our portfolio at this moment, but for all those reasons and the potential of great company, we like BAE as well, UK company systems, for that, right? For that same reason, that is in our portfolio because of the proximity of, well, the UK to Europe, the UK to the States, the UK to Ukraine. I mean, just all, and just, how it creates as a company. So again, those are long-term trends in play with real government money as well as investor money behind them. And the fact that, there's noise in the markets right now, and some of it's legitimate, again, because of the uncertainty that we're dealing with respect to tariffs and policy and social media campaigns, but also it is where we're at. So it's just interesting how those markets have diverged and what's going on there. And what can happen. And also China's relationships with Lagarde, actually. I mean, Lagarde's always had a solid, head of the IMF. She was the one really who who allowed the one to be introduced into the SDR and into the IMF basket. So there's definitely the capacity. If you do go to Eurobond, I agree with you. Should have had that in 1999. But if you do go into that environment, there's definitely funding coming in terms of government as well as private agreements with respect to China and Europe. That's increasing.
I can't hear you, Richard.
You've written a lot on uranium and in terms of other investment asset classes that make sense in this environment. Can you elaborate on that? Judd, if you could bring up the Sprott Uranium Trust as well. Do you like the uranium itself, or is it more like companies specializing in small modular reactors, uranium or thorium? Can you elaborate, Nomi?
Yeah, no, that's an excellent question. I mean, they're all of the above, and in different time frames. I mean, I think if you're looking at the nuclear energy space, you have to look at uranium, you have to look at nuclear technology, and you have to look at nuclear infrastructure, and all of that, all of those are in play, and also at policy, because one of the things that we don't hear about is where there's bipartisan agreement in Washington, and one of the main areas where there is bipartisan agreement, which is also at juncture of a big push throughout the world as well, is in nuclear energy. I mean, last administration we saw some significant acts, multiple acts, the Advanced Act, which basically looks at government support of nuclear technology, SMRs, micro reactors, and so forth. The Nuclear Fuels Security Act, which basically says we're not going to get all of our enriched uranium from Russia and from Kazakhstan. We're going to try to focus on U.S. and U.S. ally. Of course, that's question with tariffs, but basically U.S. ally deposits and production. And I think that when we look at companies that have production capacities, also in the uranium space, those are important as well as one of the components of that sector. Now, uranium has had a dive since its highs. In February of last year, when it tipped over 100, and now we're at like 60, 65 where we are in uranium. But what's interesting on just that commodity is that the spread to the futures on uranium. So futures contracts on uranium are trading about 20 points higher than spot. And what does that mean? It means that utility companies and companies in the infrastructure part, and that includes for naval, that includes for public consumption, are actually locking in contracts in the future at much higher levels than we see today. So that spreads an indication for the commodity. I think that we do have a pathway back. And one of the reasons that also I think that we've had depressed prices recently, uranium, is it's been hard to understand what this administration's policy is in nuclear. We know it supports nuclear. We know there's bipartisan support. And we also know that there's been two important executive orders that have come out of the White House this month, which basically are designed to remove certain regulations with the NRC, the Nuclear Regulatory Commission, and other permitting processes to allow quicker production and capacity to reach sort of building and development in U.S. companies and U.S. allies that would be supplying them the uranium. So and the enriched component of uranium. So these have all just come up now. And in the noise of tariffs and in the noise of Trump versus Powell and White House versus the Beijing, it's all become a bit muddied, and it hasn't gotten attention, which is, I think, why markets in general haven't been paying as much attention to nuclear companies. But these are long-term necessities for energy policy. Nuclear is the cleanest baseload, reliable energy source in the world. It produces 20% of our U.S. capacity and similar numbers throughout the world. And the growth and the plans for different forms of nuclear generation, from the small micro up through the end of that, the big constellations and restarting and redeploying coal plants and so forth, all of that is in motion in the United States and throughout the world. So I look at this space as, yes, it's part of the volatility of the markets, but it offers tremendous opportunity for the commodity and for the best companies in the space, the best in class in the space, to have significant upside because of policies that are global and also in the U.S. That support every single component of it. I can't hear you, Richard.
Yeah, good. Can't hear you.
And your final thoughts, Ira, from your perspective?
I would stand up and applaud everything Nomi said on this because, I'm a long-time subscriber to Doomberg and certainly Adam Rosenzweig and Goering, who have really been on top of the uranium for quite a long time. Because, I've read copious amounts of Vaclav Smil, and energy is so important. And it's not a non-green divide, even though, as Vaclav Smil and others have argued for so many years, nuclear was the transition. And and that's why, I was never a fan of Merkel, because she, cutting off it was just, you were building it. And it wasn't me. I go back and read stuff from warning about it in 2007, after Gerhard Schroeder ensured that Germany was going to be totally dependent upon Russian energy sources, and then of course went to take a job at Gazprom when he left office. And we're going back to 2005, 2006. But turning off those, I understand the fear out of Fukushima. I understand that, but that was just ridiculous. And actually, this is highly unusual. The French got it right, but that's because they always supported their national energy giant, right? Because so they were. The only thing I never understood is why Britain screwed up Hinkley Point so bad, especially when the ECB was begging you to borrow money at 1% or float 1.5% bonds, and it would have been the French who really benefited from those expenditures. I still scratch my head about, but I think Nomi's point is more than well taken. And cheap energy, and then we go back to the global South. And what do? We put upon them with green energy projects, which are highly expensive. To go back to Goering and Rosenberg, you talk about the energy return on investment. So wind and solar, yes, will they get there one day? Yes, but for all this time that they've been pushing this stuff down their throats, it's been very inefficient. Yeah, and you would have done far better pushing some type of nuclear. And look at who builds more nuclear than anybody else, the Chinese.
Yeah.
They'll also build more coal. The Indians are in the same camp. So you are, I would stand up and applaud. I think this is, and there are some really good companies. The one I keep up because is the symbol LEU, which I love watching. And they had a big move, and now they've corrected. Like, everybody gets enthralled, and then maybe not. We look at these, but you centrists and others, and of course, everybody got enthralled because of AI. That's just another aspect of it. And the more prevalent that AI, the more other energy costs go up. So if you're going to benefit from it, you're going to cost yourself at all kinds of other levels. And if you start cutting, as we started this whole discussion, government spending, so much of these programs have really not yielded much as far as return. And so they're going to be cut. So you may as well develop that which is far more efficient. And right now, because of the small modular reactors, nuclear energy is far more efficient than it ever. I'm old enough. I go back to the WHOOPS bonds, which were the Washington State Power Authority, which were terrible. 3 Mile Island, terrible. It was. If you projected the project to come in at $5 billion, you were lucky to bring it in at $15 billion. It's so much. We've evolved so far from there, and I think Germany's really worth a watcher, because now that you have MERS in, yes, it's a coalition government, but we'll see what the Germans do here. And the French, if they can get their act together, might actually be in a much better situation, but we'll see.
Okay, great. It's been a fascinating, insightful discussion. How can our listeners and viewers learn more about your work, Nomi?
Well, the best place now is on printsites.substack.com, and we do have our next issue, our April issue out Thursday, which is very nuclear specific, which we did a lot of work on, and I think again part of all of what we're talking about here. But that's really the best place right now.
Great, thank you. And Ira?
You can only find me here. I've limited myself. I'm not blogging. I did for all those years of writing notes from underground, which I really miss. And my international readership tells me they miss me, but it's just, I can do these podcasts and I get to be with people like Nomi. So it's the give and take, because nothing stands on its own. We each challenge each other or add to each other. And I think, Richard, you do a really good job at providing the platform for that. And the charts are you can come here and sit for an hour, and I think you'll take a lot out of it. I think our next one's with the great Mark Faber. So we'll beat him in the head a little bit. Hopefully he'll be wearing his pajamas and smoking cigarettes and make me feel like I'm back watching I Love Lucy. But these are great. So thank you for providing this.
Yep, thank you, Nomi, Ira, and Judd. Thank you so much.
Yep.
Thank you.
Thank you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.